Hi everybody, this is Asahab, I'm Giacomo, and today I'm with Toni Nasr. He's a CFA and FRM charter holder, and he did an analysis on ExxonMobil. You will find the Seeking Alpha article as well in the description. So without further ado, Toni, introduce yourself and let's see what you have done.
Yeah, hello everyone, and thank you for joining us today. And thank you, Giacomo, for having me. I'm a CFA charter holder and certified FRM. I have over 8 years of experience in the banking and finance industry. I worked as a financial controller at a regional bank, and after that, I started my own journey as a freelancer in the investment research field. I do valuations for public and private companies, and I publish regularly on Seeking Alpha and some other fintech related websites. And recently I founded Victory Invest, an investment research firm, and launched a newsletter on Substack. Today I will be presenting on the valuation of ExxonMobil using a regression model. I believe this presentation will provide a deeper understanding of the factors that drive Exxon's revenue and its future prospects. And I hope that it will add valuable insights for everyone. So let's take a look at what I will be tackling today. In this presentation, I will be covering a high-level overview of the company and its operations, a brief financial analysis of Exxon, including its financials and its report, 2022 report. I will discuss the ExxonMobil's energy mix. It's a report that was published by Exxon last October. I will give an overview of the regression model that I will use to value the company, including a discussion of the assumptions and the methodology behind the model. I will also discuss the strengths and limitations of this model and how it can be used to provide an estimate of Exxon's revenue. Then I will do a projection of the first quarter's revenue of 2023 based on the results of our model and some assumptions that I'm going to explain. I will also find or estimate the intrinsic value of Exxon based on 3 different valuation metrics. And in the end, I will summarize the key takeaways from the presentation and provide some final thoughts on the valuation of Exxon. So let's dive in and start. Before that, I want to make sure that you take a moment to read the disclaimer on this slide. So the information in this presentation is based on publicly available data and my personal opinions. And it is for general information purposes only. So it should not be relied upon as an investment advice. So do your own research, consult with your advisor before taking an investment decision. So I suggest that you pause the video, take a moment to read the slide before we continue. So a brief overview of ExxonMobil. It was founded in 1870. It has become a leading energy company operating globally and employing over 63,000 people. The company's primary business is the exploration, production, and sale of oil and natural gas. In 2022, it delivered impressive results with earnings of 55.7 billion and cash flow from operating activities of 76.8 billion. The company set new records for refining throughput in North America, and it started one of the largest advanced recycling facilities in the region. If we examine the performance of each of the company's segments in 2022, the upstream segment contributed to about 64% of the total earnings, with full year earnings of 36.5 billion, which is an increase of 20.7 from last year's numbers. The energy products segment made up about 26% of the total earnings, with full year earnings of 15 billion compared to a loss last year of 0.3. The chemical products had full year earnings of 3.5 billion, which is above the 10-year average, but below the record registered last year, which was around 7 billion. This segment contributed around 60% of the company's total earnings. The specialty products segment made up around 4% only of the total earnings, with about 2.4 billion compared to 3.3 last year. Those percentages were calculated after excluding the corporate and financing segment, which had a full year net charge this year of 1.7 billion. ExxonMobil's 2022 financial performance was outstanding, with a 32.7 billion increase in earnings from last year's numbers. The company saw improvements in price and margins. It saw favorable market conditions, volume increases, and several structural cost savings. The 87% total shareholder return and 25% return on capital employed were the highest since 2012. So also with 22.9 billion in added cash and 62.1 billion in free cash flow, the company was able to reduce its net debt capital ratio to 5% only. So its balance sheet is very light, and it's a very solvent company. To show its commitment to shareholders, Exxon declared a $0.91 dividend per share in Q1 and increased its share repurchase program with a potential 35 billion in cumulative repurchases in 2023 and 2024. During their last earnings call, which was last week, the CEO highlighted the company's strong financial results, outpacing several industry peers in terms of growth in earnings, return on capital employed, cash flow from operating activities, and he mentioned that the company's focused on cost saving and efficiencies has led it to nearly 6.9 billion in structural cost saving, and their target is to achieve 9 billion in savings by 2023. So now that we have reviewed the financials, let's dive deeper into the results of our regression analysis. In this model, we aim to predict the revenue of the company based on the average prices of three commodities: Brent crude oil, WTI crude oil, and natural gas. Why I have chosen those three variables? As you can see in the charts, there's a very strong relationship between revenues of Exxon and those three variables. For example, in the first chart, it is a very strong relationship between the revenue of the company and WTI and Brent. It's clear that there's a straight line in this chart. So once the prices of these commodities increase, the quarterly revenue of Exxon increases. And the regression model here aims to quantify that change in order to predict the revenues accordingly. Now, to check the outlook of oil and gas industry in general, I checked the energy outlook report released by Exxon last October, which projects that the world will use 15% more energy in 2050 than it does today. So all energy sources remain necessary through 2050, even in independent net zero scenarios. So the outlook projects that oil and natural gas will account for 55% of the world's energy mix, with renewables mostly displacing coal. So natural gas demand will rise, largely to help meet needs for electricity and the lower emission goals of companies. Accordingly, oil and gas are here to stay. And we can assume that they will present a major part of Exxon's revenue for the upcoming period, at least until 2050. So I ran a regression model to get the results. So as you can see in this slide, we have used a multiple linear regression to arrive at this model, where the revenues of the company here, the revenues of the company is the dependent variable, while the average prices of the three commodities serve as independent variables. We have the intercept, which is a constant, and the three variables with their coefficients. The coefficients in the regression equation provide an estimate of the impact of the firm's revenue of a unit change in each of those independent variables. For instance, if we observe an increase in the average quarterly price of Brent crude oil, we can expect the revenue of the company to increase by 806.67. So each $1 increase in average in Brent crude oil, the company's revenue will increase by $806 million on a quarterly basis. Similarly, for the average quarterly price of WTI and the natural gas. So our regression was developed using 44 quarters of data, giving us a comprehensive understanding of ExxonMobil's revenue over time. So the statistics on this slide provide valuable insights and will help us make informed decisions about the company's future revenue based on the changes in those three variables. First, if we look at the R-square metric, the R-square measures the proportion of the variation in ExxonMobil's revenue that can be explained by the average price of those three commodities. So we have a 0.9686 as R squared. We can see that 96% of the variation in revenue can be explained by the change in WTI, Brent, and natural gas. Next, we have the adjusted R square, which takes into account the number of independent variables. So sometimes in a regression model, if we add several factors, it won't be a good model anymore. So the R square measures this metric for the model. Our 96.62% is relatively high, which further confirms that our regression provides a good fit for the data. The last metric that I want to talk about is the standard error, which measures the variability of the residuals. So it's the difference between the actual and the predicted data. So for example, based on our model, we might have an error of 3.91 billion in estimating Exxon's revenue, which is really a small proportion in terms of the company's whole revenue. So from these regression statistics, we can conclude that our model provides a good fit for the data and has a high level of accuracy in predicting the quarterly revenue of the company based on the changes of those three variables. Now let's present the pros and cons of the regression model that we created. First, starting with the pros, it has a predictive power. It's one of the biggest advantages of this regression model. And so the equation provides us with a quantifiable relationship between the dependent and the independent variable. This allows us to predict revenue based on changes of these commodities. Second, it's insightful coefficients. This is another advantage. The coefficients of the regression equation provide an estimate of the impact of the firm's revenue for a unit change in each of these independent variables. So we can understand how changes in each of those commodities it will affect Exxon's revenue. And it's easy to use. So we just plug in the average price during the quarter of Brent, WTI, and natural gas, and we can estimate the revenue without waiting for the firm to release their report after 1 or 2 months after the quarter end. Now let's talk about the cons of the regression model. The first one is the assumptions. This is a linear regression, which is assumed which is a relationship between independent variables. This relationship may not hold always. So it assumes that the independent variables also are independent in terms of variation, while in real life, this is not the case. So an increase in natural gas will ultimately drive to an increase in other oil products. So this is the first cons. The second one is the limited scope. So the model only considers 3 variables, which may not capture all the important drivers of the company's revenue. Other factors such as macroeconomic indicators, geopolitical events, or changes in industry may have a significant impact on the revenue and are not accounted for in this model. The third disadvantage, if we can say, is the average prices of Brent and WTI and natural gas are outside the control of the company. So they are subject to market forces. This means that the company cannot directly control the variables that drive its revenue, which can make it difficult to plan for the future. However, in conclusion, if we want to conclude the slide, we can say that the regression model provides us with valuable insights into the relationship between revenue and the 3 variables, which are commodity prices, but it also has some limitations that should be considered when doing the projection. Now, in order to get a market assumption and project the first quarter's revenue of 2023, I looked at the U.S. Energy Information Administration, EIA, their outlook. They released an outlook during Jan, I think during the first half of Jan, where they forecast that the Brent crude oil will have an average of $83 per barrel in 2023, which is down relative to last year, to 2022. And they expect it to continue falling to $78 per barrel in 2024. On the other hand, WTI, West Texas Intermediate price, is forecast to generally follow also a similar path. The average is at $77 in 2023 and around 72 in 2024. So our assumptions in this model are Brent at 83 and WTI at 77. Now, moving to the Henry Hub natural gas spot price, EIA expects that the price is slightly less than $5 at $4.9 per million British thermal units in 2023, which is down also relative to last year, which is down maybe 25%. So our assumption here also is 4.9, which will be added to our model. Taking this projection into consideration, I have estimated the revenue of the first quarter to be $83 $0.36 billion for Exxon. This revenue projection takes into account the expected changes in the prices, which are key drivers in the company's revenue. And accordingly, by the end of the first quarter, if we add those three and the projected one in Q1 2023, the 12-month trailing revenue will be estimated at $397 billion, which we're going to use in our valuation. Now, to estimate the overall value of the company, we will be using three commonly used valuation methods. The first one is EV to revenue, the second is price to earnings, and the third is price to sales. Our projection for the 12-month trailing revenue for Exxon by the end of the first quarter, as we said, is the sum of those three and this one, which is $397 billion. So if we apply the average EV to revenue of the company for the last 5 years, which is 1.335, we arrive at an estimated enterprise value of 530.010 million, which is EV to revenue times projected revenue by the end of first quarter. Now, to determine the fair equity value, we do the adjustment. We subtract the company's debt and minority interest, and we add back the cash position. So the fair value will be estimated, the fair value for equity will be estimated at $511 billion. If we divide by the average shares outstanding, which was released last week in the 2022 report, the fair value per share will be at $123.65 based on the estimates of the EIA outlook. The second valuation method is the PE ratio. We will be using the average net margin over the last 8 quarters, which is 10.73%, and the average PE ratio at which the firm has been trading in the past year, which is also 11.75 times. Based on these metrics, the fair value per share is 120.96. So we divided the earnings by the number of shares outstanding. We got the earnings per share. We multiplied it by the PE ratio, which is 11.75, and we got $120.96 as per the PE ratio. The third one is the price to sales ratio, where we will be multiplying the company's projected 12 trailing months revenue by the average price to sales over the last 12 months, which is 1.185, multiplying it by the revenues, which are the sales, the 12 trailing months sales, 397. We get a fair value per share of 113.69. So if we do the average of those three valuation methods, we arrive at an estimated fair value of 119.44 for Exxon by the end of the first quarter if the prices, oil and natural gas prices, are met as expected by the EIA outlook. Now, the conclusion. Our analysis of Exxon has highlighted the significance of commodity prices in determining the revenue of the company. So we have developed a multiple linear regression to estimate the revenue of the first quarter. You can do it for the other quarters. Maybe by the end of each quarter, you can do this exercise and get an estimate of the company's revenue. Our assumptions are based on the EIA outlook. Personally, I'm more bullish on the oil price. So I applied a higher price on the Excel, and I got a new average share price, fair value for Exxon. It's important to note that while our regression provides valuable insights, it is just one piece of the puzzle. So investors must consider other factors before making an investment. Maybe the current market conditions will change. Maybe geopolitical tensions will ease or be more. There's more tension, maybe. So all these factors should be accounted for whenever you make an investment decision. However, investors who are bullish on oil price might find that the company is undervalued now, especially that it's trading between 113 and 115, $116 per share now. So on the other hand, those who believe that EIA's projections are reasonable may find that the company is fairly valued at current market prices. However, again, all market factors, market trend, industry trends should be taken into consideration to make an informed investment decision. Finally, I want to thank you for your attention, and I hope you found this analysis insightful.
Yeah, sure. Very insightful. You did a great job. I'd like to make a few questions. First of all, given the effect that geopolitical tensions have on the oil prices and therefore on ExxonMobil, what are the possible black swans that you expect that we could see in the foreseeable future, like OPEC, aside from Russia, Ukraine? What are the main risks and benefits that you can see in the foreseeable future for the oil and gas sector?
So I think that the Russia-Ukraine war currently is getting a bit into more peace agreements. However, whenever the oil price is gonna drop, OPEC Plus will decrease their supply and will try to maintain a higher price for oil, especially that it's in their favor. While on the other hand, the US are favoring lower oil prices. So in the foreseeable future, I might say that the oil price per barrel might not exceed $100, but it might not be below $80 if all the geopolitical tensions and OPEC Plus sustain a relatively stable oil price near $90 to $100 per barrel. In terms of natural gas, for Europe, we don't have any more a crisis. We still have a high need, a high demand, but we don't have the expected crisis. So it might be around the levels expected by EIA. But in terms of oil, I'm more bullish on the oil price.
So another question that I would like to ask you is, does it even make sense to value Exxon based on what competitors are doing, given the capital structure that Exxon has? Does it even make sense to compare it, I don't know, with British Petroleum, Shell, or other oil companies? Or Exxon has a capital structure that is very peculiar, therefore it doesn't make sense to really compare it with competitors?
No, I think that Exxon can be compared relative to other companies in the industry. For example, the profit margins can be compared between Exxon and British Petroleum or Shell or CVX, any other company that is a real competitor to Exxon. Plus, we can compare the company based on the discounted cash flow, which I did not do now, but we can do it based on the DCF try to project the revenues and the cash flows for the upcoming 5 years and get present value of the company. However, regarding the discounted cash flow, it's a really hard thing to do for oil companies, especially with the uncertainty in oil prices. So you're not really able to predict with accuracy the revenues of the company for the 5 years and apply terminal growth rate. So maybe it can be done, but it might be hard to find real assumptions that are valid for the upcoming 5 years. So no one was able to predict the Russian-Ukraine war. So no one will know what will happen in regards to ESG implementation in the next 5 years. So it's really hard to predict 5 years from now the revenues of the company based on the oil prices and get a valid DCF.
Okay. And another question that I would like to ask regarding the cost of capital, the dividends, and so on. We've seen the last year that many companies, given the high cost of capital that they have in this sector, they would rather distribute dividends or pay a premium dividend rather than reinvesting the money into new projects. Do you see that coming for Exxon, or Exxon is on a different track?
As their CEO said in the latest earnings call, they increased dividend and they also increased their repurchase program. So it has a potential 35 billion repurchase in 2023 and 2024. So Exxon does not pay a special dividend like European companies. They tend to repurchase their shares, return value in terms of dividend and share repurchase programs. So dividends is already increasing, and I'm expecting that it will keep on increasing as long as the company is able to pay dividends. And it's clear that it will be able to pay dividends. It has a very light balance sheet, decreasing that. The net debt to capital ratio is only 5%, which is good for the company. So I expect if they have excess capital, if they have excess cash, they're gonna repurchase shares during the upcoming 2 years.
Okay, great. Thank you for the clear answers. So this is it for today. Thank you, Toni, for your presentation.
Thank you for having me.
And so this is it for today. I'm Giacomo. This is Also Hub. See you next time.